Just all the signs that we're seeing with reopening, property support. This time it's with these bad debt managers that are kind of working with the PBOC regulators to offer that more support. How confident are you of this turnaround that we're seeing?
Okay, I think to begin with, we do see the policy change in terms of stance compared to last year. So first of all, they've become a lot more pro-growth and to some extent pro-business. And if you want to kind of zoom into property, they have been trying to provide a lot more financing support from loans, bank debts, debt market kind of access, to even allowing them to issue equities for refinancing purposes in the onshore market. And recently, we also see some of the state-owned bank working with developers in the offshore market, potentially providing support on financing whilst using some of the onshore assets as kind of leverage as well.
We've seen quite a big rally when it comes to junk bonds in China as well. I think, a lot less, at least some of these developers are under 20 cents to the dollar now, which was kind of a norm last year, as crazy as it sounds. And so we're coming out of this kind of deeply distressed territory. Do you think that can continue?
Okay, I think there's two parts of it. One is the financing support that I've talked about earlier on, but we also need to be mindful that it's only for the higher quality developers. They have a white list that potentially are the companies of higher quality, likelihood of survival is higher, so they're willing to extend support to some of these companies. Whilst on the other hand, we're looking at the physical market, particularly on the contract sales side, it's still quite weak. So it probably will take some time before the contract sales or the physical market rebound. And that's why we start seeing a lot of kind of supply-demand policy coming through, lowering in terms of mortgage rates, encouraging home buyers to come back to the market. But at the end of the day, we still need to look at the whole macro picture. Given the kind of weaknesses of the economic backdrop, the propensity of people to kind of go into the property market to purchase property would be highly hinges in terms of the economic recovery as well.
So you're staying on the high quality companies, not just in property though. You're looking at tech, casinos alike too, right?
Yeah, so that's probably more hinges on the reopening story that we've been talked about a lot in the market at the moment. That will really kind of boost several sectors. Consumption, particularly domestic consumption. We also think that is likely to boost tourism. Macau gaming, which I think for the past 2 years have been in a quite difficult time because they have heavily reliant on Chinese tourists. Hopefully, as we move into this year, they'll probably have a little bit of a better operating environment. I think finally, the Central Economic Working Conference also highlighted a few sectors, which is the private sector as well as the tech sector. We also see some of the kind of regulation risk related to the tech sector has already peaked as well.
Okay. A lot of what we're seeing spreads kind of narrow, but it's also because of the Fed story as well. We had a guest yesterday that said, look, I'm confident with the China reopening story. I'm not as confident with what's going on in the US or Europe, where he was saying things are just priced to perfection. Are you confident on the Fed downshift too? Okay,
I think there is. Well, I think last year, a lot of us trying to get this right. And I think it's proven it was quite challenging to kind of get the duration call right. And I think what we have been seeing now is that we start seeing inflation data peaking. And that's coming through on the actual data. So that's first of all a good sign. I think the other thing we also need to be mindful of is the China reopening. Is that going to have any impact in terms of the global inflation outlook, which potentially will be another consideration for the Fed when it comes to the decision in terms of the rates. But overall, we do think as we move into where we are now, 2023, duration risk is very attractive right now. So for our fixed income capabilities, we're looking to be gradually nimbling, adding on in terms of duration.